On September 16th, 2024, the Canadian government just came out with some changes really impacting homeowners and people looking to get into the market. It's really shaking up the Canadian housing industry and raising quite a few eyebrows with experts. Let's see how this affects you, because it will on some level, whether you're a new buyer looking to get into the market or considering getting off the fence, pun intended, and actually purchasing your dream home. This will affect you most likely on some level and affect your mortgage and buying decisions.
You do the math, this minus that, that's almost $250 a month extra in my pocket that I get to keep.
So enough chit chat, let's just get right into it. And for those of you new, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I discuss personal finance, investing, and things related to Canadian housing. If that's something you'd be interested in, consider subscribing to my channel. Now, I'm sure you've heard other videos or maybe articles talking about the Canadian mortgage and the new rules surrounding it. However, the devil is in the details on some things that were just glossed over that you may have missed. So in this video, there are certain things that just may shock you and other things that maybe you just didn't know due to all the misinformation out there, such as who qualifies as a first-time home buyer. Most people would say, oh, I know, it's someone who's never owned a home before in their life.
No.
This is incorrect. Going by what the eyes of the government classifies as a first-time home buyer, here's the actual definition. Basically, in its most simplest terms, you have not owned or jointly owned a home in Canada within the last 4 calendar years.
So as long as someone is a Canadian resident, has not owned or jointly owned a home in the last 4 years, or has recently become separated from their partner for at least 90 days, they would be considered a first-time home buyer. Hence, you would be considered a first-time home buyer even if you owned a home many years ago but had to sell it for a number of reasons, such as a downturn in the market, the COVID pandemic, job loss, and so forth. You would still be considered now a first-time home buyer.
Surprised? Most people have the definition wrong. But these changes, make no mistake, are pretty controversial to say the least. Now, there are pros and cons to this, which I'll go over later in the video. So one of the big first announcements is the Canadian government is raising the cap on mortgages from 1 million to 1.5 million, and you only need 10% down. So under the new structure, if you buy a home that's $500,000 or less, nothing changes. It's still 5% down. However, now, like I said, the cap has been raised from 1 million to 1.5 million. So now any home priced at a sale price of $1.5 million or less is only subject to a maximum of 10% down payment, meaning the first $500,000 is still taxed at 5%, but between $500,000 and $1.5 million, that $1 million is only subject at 10%. So I'll give you some examples because I know it's kind of confusing and a little bit hazy. So under scenario 1, Tom buys a house for $450,000. The down payment he would need would be $450,000 times only 5% would be $22,500, because all of this, the wholesale price is less than $500,000, so it's only subject to a 5% minimum down payment. Now, in scenario 2, Michelle buys a house for $750,000, and now that amount over the $500,000, that $250,000 is subject to 10%. So people are making the mistake thinking that, oh, anything under 1.5 million is subject to a 10% minimum down payment. This is not the case. It works just like tax brackets. So the amount between 500,000 and zero is subject to 5%. The amount over $500,000 is subject to 10% minimum down payment. Between 1.5 million and $500,000, that amount is subject to a 10% minimum down payment. Now, anything over 1.5 million is subject to a flat 20% minimum down payment on the entire amount. There's no way around it. So for scenario 3, Sam buys a house for $1 million. $500,000 is subject to 5%, and the remaining $500,000 above that is subject to 10%, giving him a minimum down payment of $75,000. Now for scenario 4, Emma buys a house for $1.2 million. That first $500,000 is subject, of course, to that 5% minimum down payment. and that amount over the $500,000, that next $700,000 is subject to 10%, giving her a minimum down payment of $95,000. In scenario 5, Walter buys a home for $1.6 million. That entire $1.6 million is subject to a minimum down payment of 20%, meaning he has to have a minimum down payment of $320,000. Now, for all of these, you need mortgage default insurance, and that's what this is saying, is that you'll still be covered for mortgage default insurance. As soon as you're over 20%, the banks look at you and say, well, they've made 20% at least for the minimum down payment. They're not as risky, so they no longer have to have mortgage default insurance. Now, this is not to be confused with your homeowner's insurance that you get when you buy your house and covers your belongings in case of fire, theft. If anything happens to your home or your property, you're covered under your homeowner's insurance. This is something different. Hey, if you feel like you're getting something out of this video, would you do me a favor and hit that like button, as it really helps out my channel with the YouTube algorithm and is very, very much appreciated. Mortgage default insurance is actually there to protect the lender, not the borrower. So people think, oh, I have it to protect me in case I default on my loan. No, it's actually to protect the banks who are lending us the money. So in case you default on your loan, the Canadian government says, hey, we'll support the banks and make them whole again if these borrowers default on their mortgage. So it's actually protection for the banks. So now under these new guidelines, you can now have mortgage default insurance and have only a minimum down payment of 10% if your home is over $1 million. It was always regarded as an invisible barrier, like most people couldn't afford a home over $1 million. However, these rules haven't been amended since 2012, and with the price of homes, the Canadian housing crisis that everyone's going through, the Canadian government said, well, we have to adjust this. We have to make it so more people can get into the market and buy a home. The second major change that the Canadian government is going to make is to allow more 30-year amortization. So it stretches out the period you have to repay your loan. Amortization is actually an accounting term. I know it sounds scary, but it's really not. It's pretty simple. It just means the amount of time you have to pay back your loan. So usually, Canadian mortgages used to be usually a 25-year payment term or amortization. Now they're saying, now we'll stretch those payments and allow most people that apply for a mortgage a longer period, by 5 years, in order to pay off their mortgage. So now, as opposed to only having 25 years to pay off your mortgage, you can now have the option to take out a 30-year mortgage loan. So you have 5 more years to pay back your mortgage. This will reduce your payments somewhat. And so the goal is to make it more affordable for the average Canadian. That's why this new structure is coming into place in theory by the Canadian government, because homes are so expensive, they're saying. So they're like, well, how can we make it more affordable for the average Canadian to get into the market? So to give you an idea of what your monthly interest payments would be every month, if you purchased a house with a sale price of $750,000 with 10% down payment, and you amortize that over 25 years, your monthly payment would be approximately $4,557, roughly. However, if you were to stretch that same $750,000 over now a 30-year amortization period or mortgage term, your monthly payments would be $4,226, so approximately just over $300 less. Not great, but every little bit helps. So it does help in the longer term. If you're kind of on the edge and can't really afford a home, that $300 might just be enough to get you into the market. However, a substantial amount more will be going towards interest over the long term. It's estimated that people that get these 30-year amortizations could be paying up to $100,000, maybe even more, towards interest that they would have never paid if they only had a 25-year amortization period.
Because I'm paying back my loan over such a long period of time, I'm paying a ton of interest. So I'm not just paying back $494,000. On a 25-year loan, I'll actually end up paying $861,938.59. That's almost $368,000 extra dollars just in interest. But on a 30-year loan, my total payback jumps to almost $950,000. So now I'm paying back nearly double the original loan. more than $80,000 extra compared to the shorter 25-year loan.
So who exactly qualifies for these 30-year amortization mortgages? Well, let's take a deep dive into that. Expanding eligibility for 30-year mortgage amortizations for all first-time home buyers and all buyers of new builds, new project constructions. Did you catch that? New builds and new project constructions. That's a tiny detail, and we'll get back to exactly what that means. So the government is pumping and promoting that, oh, everybody when they read this title think, oh, it's for first-time home buyers, great. Well, not only them. This is also for anyone who hasn't owned a home within the last 4 years and people purchasing new project constructions. So investors are also quietly investing into the market as well. Many people fear that this will continue to raise home prices up even further, causing housing to become even more unaffordable than it already is. This won't really solve the problem. The Canadian government is trying to balance and play both sides of the fence because its numbers in the polls are slumping, so it's trying to say, hey, first-time home buyers, people wanting to get into the market, we're helping you. But they're helping investors and other people at the same time. So it's really just elevating housing prices and causing, or will cause, many experts say, house prices to go even higher.
I see purchase prices and property values increasing as well.
Greater the demand and with limited inventory is going to drive pricing upwards.
Experts are claiming that, well, this isn't really solving the problem. It's just getting people to leverage more debt, take on more. And this is proposed by the Canadian banks because, well, the burden is not on them for these big loans. It's on the borrower. It's not on the lender. It's on the people borrowing the money. And if they default, well, it goes back to the Canadian government to bail out the banks. And, well, that comes from the Canadian taxpayer. So, in a sense, we're paying for this. If we aren't now, we will be soon.
Extending mortgage insurance and amortizations just increases the buying power of borrowers, and it's going to tend to push housing prices even higher. I know the real estate industry is happy enough, but that doesn't help affordability.
No, you're right.
If you feel like you got something out of this video, like I said, hit the like button and consider subscribing if you want to learn from a 20-year Canadian corporate accountant. So on the one hand, I'm kind of undecided if this is a good or bad policy, as well, this does get some people who want to get into the market a chance to get in there and buy their dream house. However, on the other hand, they'll be really highly leveraged. Their debt will be through the roof, and if its interest rates go any higher than they already are, I hate to see what will happen. We're already seeing a surge in mortgage delinquencies, and this could continue even higher if a lot of people default on their mortgage. So why people are kind of skeptical about this is, well, who is looking as a first-time home buyer to buy a $1 million home? Like, who is this really helping? However, in certain areas, cities in Canada, that's close to the average price of a decent-sized family home. So rather than deal with the housing prices and trying to bring them back down, correct the imbalance that they have, they're leveraging people and forcing them to take on more debt. However, now they don't have to worry as much about stress tests and they are able to buy the home of their dreams. However, their budget will really be stretched to the max.
The first big downside to stretching out a loan, you pay less now, but you pay more later. And that really sucks if you're already looking forward to getting out of the rat race. Check out how Canadians have, over time, been retiring later and later in life, from a median age of 60 about 15 years ago to about 65 more recently. Add more debt, maybe you push your golden years back a little further too. You're also building equity in your home more slowly, meaning with each monthly payment, less of your money goes towards actually owning your house and more goes towards servicing debt.
Fortunately, in my opinion, both people can't win this game. You know, like you can't support investors and people that own a home and also support people who aren't in the market that want to buy a home but bring housing prices down. Somebody has to lose, and the government's trying to support both people and say, well, we're going to listen to both sides, particularly investors. The government's choosing to focus on because they represent more of the voting market. So they don't want to lose that voting share. by supporting first-time homebuyers who aren't in. So they're choosing to go with investors. And I feel that the Canadian government has to get out of real estate, that they have to stop trying to control real estate, getting people to invest, and they have to get more people into productivity in Canada. Get out of the housing market, get out of real estate, stop seeing Canada as a place for real estate investment, and get other industries into Canada. Unfortunately, speculation is driving a large part of the Canadian housing market. So when house prices dip a little bit and some people can get in, people often snatch them up quickly, figuring, well, housing prices are just going to go up in a few months. I better get in now while I can and wait for them to go back up. Unfortunately, a lot of other people think the same way. So again, once there's a small dip, it suddenly shoots back up after a few months. So let me know in the comments if you think this is a good or bad move by the Canadian government, who this is helping, and if this actually helps or hurts Canadians. Some people, I'm sure, it will help them get into the market and buy their dream home. Other people aren't so sure and view this as, well, they're just trying to gain temporary favor, and this doesn't really help anybody in Canada, except a very, very small portion of the population. And a third problem is, when it comes December 15th, a lot of people are anticipating that investors and other people are going to suddenly jump into the market. They're going to want homes too, and this is going to cause a surge in housing prices. We'll see what happens, but that's the kind of sentiment I'm hearing and reading. So we'll see what happens on that front. If you're wanting to maybe avoid this, you might want to get into the market earlier. However, it might be worth renegotiating your contract after December 15th and see what kind of rates you get, what you qualify for, and consider that as an option as well. If before you'd be kind of tight and wouldn't be able to make your payments before, but now under the new legislation rules effective December 15th of this year, you might qualify for more of a house or be able to get into a house bigger that you actually wanted. If you're curious why owning a home back in 1995 was so much more affordable despite interest rates being 3 times higher than what they are now, click this next video here. And if you're curious about some of the factors related to the downfall of Canada and it's not exactly what you think, you might want to watch this next video here.